Did you know the best investors are dead investors? But what do ghost and successful investing have in common? Could becoming a financial zombie make you wealthy? Well, stay tuned as we look at how to successfully save and invest just like the undead. Hey everyone, this is AJ, your ace in the hole, and welcome to the channel where we simplify personal finance, providing tips for young adults, parents, and anyone else looking for some insight. And sometimes we take note of an outrageous financial study to help you build a lifetime of wealth. And if this sounds interesting, please take a quick second to click the like and subscribe button to check out lots of other content just like this. Let's start out with this dead investor thing. In 2014, Fidelity Investments conducted a study of the best performing investment accounts and found that the highest returns belong to dead investors. Now, this was somewhat metaphorical in that this primarily meant accounts with no activity, possibly forgotten, misplaced, or could have very well come from those who had passed on with no remaining family members or listed beneficiaries. The point being, these dormant accounts perform better than actively managed accounts. Now, how is this even possible, you might ask? Well, let's get into that and walk through 5 ways your living self can successfully save and invest like a dead person. Vanguard Group founder and index fund pioneer John Bogle has said regarding successful investing, "Don't do something, just stand there." This was in contrast to the emotional reaction most investors have during monstrous stock market swings, frantically buying and selling, which historically never ends well. This, along with additional wisdom provided by billionaire zombie investor Warren Buffett, who classically stated, "Do not save what is left after spending, but spend what is left after saving," makes for the perfect combination. A basic principle so simple yet overlooked by so many, which is to automate everything. Now, the suggestion of automated savings and investing may not sound like any sort of grandiose insight. However, the Bureau of Labor and Statistics reported that as of 2025, of the 72% of U.S. workers that had access to retirement benefits, such as a company 401k, only 67% voluntarily participated, while the Vanguard Group reported that automatic enrollment plans reach a 94% participation rate. So this one metric alone helps show the importance of automation towards personal wealth building. Now, the lack of participation is not necessarily intentional. Remaining consistent with manual savings and investing is hard, requiring constant attention. Let's face it, we all get busy and, well, life happens, creating distractions that can easily derail savings efforts. Automation, however, helps remove that from the equation. The trick is creating an automated system that handles everything, simplifying the process. This not only stabilizes your savings by consistently paying yourself first, but also removes the temptation to tamper with investments when market shifts occur, which, as the study showed, does far more damage than good. Again, don't do something, just stand there. Let's first talk about the benefits of automating your finances, and then I'll move into ways to accomplish it. This starts with the golden rule of personal finance, which is to pay yourself first, prioritizing saving over spending. Automatically transferring a portion of your paycheck to your savings or investment accounts, for example, helps solidify this. By doing so, you acclimate to your take-home pay, and before you know it, you don't even miss it. Out of sight, out of mind, as they say. Then, as you receive pay raises, your savings as well as your take-home pay increase, and you never even notice. The next benefit is automating your investments. This allows you to use recurring investing to dollar cost average, or DCA, which is a very effective investment strategy that is a proven disciplined method to build wealth over time, and ironically is one of the simplest. That all seems to fall apart when managed manually. I have a future video planned that dives deeper into DCA, but in short, this is where you invest a certain amount on a consistent basis, regardless of whether the market is up or down. This effectively smooths volatility and market risk, avoids emotional reactions, and consistently buys more shares during market dips. Here's a quick illustration of how DCA works in practice. Let's assume you have $5,000 to invest. You could simply make a $5,000 lump sum stock purchase of 250 shares of a company at $20 per share, for example. Or you could instead DCA, buying $1,000 worth of shares for 5 consecutive months. Since stock prices are always fluctuating, each month the price drops, you'll be buying more shares for your $1,000 and less if the stock is up. However, after the 5 months, you would now have purchased a total of 263.3 shares for a dollar cost average stock price of $18.99. You can see how DCA takes advantage of market fluctuations, accumulating more shares over the long term. Now, let's get into 4 ways you can secure all of this using automation, plus a 5th bonus option, collectively creating a simple, hands-off approach to saving and investing, all while accumulating wealth in the background. basically placing your personal financial system on autopilot. Simply set it and forget it. First up is payroll deductions. Most employers offer the ability to directly deposit paychecks to personal accounts, such as a checking, savings, or a company 401k. Many companies even requiring it. One example is to set a certain percentage of each paycheck to fund a 401k or savings account, with the balance or your take-home pay directed to your primary checking account. You never see the savings, which helps you not spend it. Again, paying yourself first. I'll touch on what you can do if this is not offered by your employer shortly. But once you have automated this first step, you can head to the next stage of automation, which is bank account transfers. Automating bank account transfers allows you to move money between various accounts on a desired schedule, for example, weekly or monthly. These might include transfers from your checking account to a high-yield savings account, a brokerage account, an emergency fund, or even a health savings account or HSA. For instance, this can allow your primary checking account to be a central hub for your payroll deposits that you can then transfer out to other accounts, all done automatically and hands-off. This is also a great method for moving out manually deposited money in the event you're paid in cash or, as I stated earlier, your employer doesn't offer direct deposit. As an additional example, Fidelity Investments even offers smart habit challenges to help promote automated savings, as they know all too well how much automation can help you save more over time. Next, once you move funds to the appropriate accounts, is automating investing. As mentioned earlier, this is where the magic of dollar cost averaging really takes hold through consistent investing. This can easily be set up within most investment accounts, such as automating how your 401k contributions are invested or using automation within a brokerage or other investment account. Simply choose the amount, the desired investment, and the frequency. From there, it's all hands-off once you set up the recurring transactions. Another more advanced strategy is automating escalation. This is where you automate contribution increases over time, for example, in conjunction with pay raises. This is a great way to increase savings and investment contributions without even realizing it. This is one of the ways I personally increase savings over my lifetime, increasing my contribution rate every time I received a pay raise, what I call my 50-50 savings rule. This is one of my top personal financial principles, which I touch on in my 10 Commandments of Personal Finance video, which I link below. Using this method, you'd never really feel the effect of increasing savings levels as you share the increase with your take-home pay as well. A neat way to trick yourself into saving more without ever noticing. Now for that bonus tip. While not directly related to saving and investing, it does have financial benefits, which is setting up automated bill pay. This can be done with home mortgage payments, monthly rent, car loans, utilities, and especially credit cards, which have incredibly high interest and penalties on late payments. Setting up auto bill pay, especially for major recurring payments, is a great way to avoid these charges, which can put a wrench in your savings plans. The last thing you want to do is spend unnecessarily on fees or penalties that can be completely avoided. So now you can see why automating your finances matters. Even with the greatest intentions, many fail to maintain consistent contributions due to busy lives, distractions, or lack of priority. Setting a solid system in place means you don't have to decide every month how much to save or invest, combating common barriers like procrastination and decision fatigue. Automating everything helps close that gap, leading to a significantly better financial outcome over time, which is ultimately the moral of this story. All that said, I really hope you found this video helpful and would love to hear your thoughts. What's your opinion on automating your finances? Do you already use automation in some form? And if so, are there any additional benefits you'd be willing to share? If so, leave them in the comments below to share with others. Now, before you go, if you haven't, be sure to like and subscribe as it helps the video reach others that might also find it useful. And don't forget to check out my 10 Commandments of Personal Finance video here for many other helpful tips. And remember, it's not how much you save, it's how early you start. This is AJ, your ace in the hole. See ya!